Good afternoon, ladies and gentlemen. Thank you for joining us today. My name is Ajisafe, and I'm a member of the Renaissance Capital sales team, and I have the pleasure of hosting this afternoon's panel on digital lenders and neobanks. Co-hosting with me this afternoon is Tage Kene-Okafor, the Africa reporter from TechCrunch, an international online publication dedicated to technology, venture capital funding, and startups. Our esteemed panelists include Tolulope Omoleye-Osindero. She's the head of legal and compliance at Branch. Branch International is a leading finance app that provides loans, investment, credit scoring, and transfer services to its customers. Branch has over 6 million customers in Nigeria, Kenya, Tanzania, and India, and to date has provided over 20 million loans to its customers across its operating markets. Laurin Hainy is the CEO of FairMoney, an online bank focused on servicing frontier and emerging markets. And Chijioke Dozie is the co-founder of Carbon, an online bank with operations in Nigeria, Ghana, and Kenya. Thank you for joining us.
Thanks for that, Abby. So I'm Tage Kene-Okafor, a reporter for TechCrunch. We know all the companies here are lending companies are, online banks. But what I would like to know is the evolution of your businesses from when you started it and what it is now. So if each and every one of you, Laurin, Chijioke, and walk us through the evolution of your business. What you had in mind when you started the company and what it is today. I think I'll start with Chijioke.
Thanks, Tage. So I think with Carbon, we've had many names before. So we started off as a lender, a consumer lender, and we were actually offline. At the time, we were called One Credit. In a couple of years, we decided that we couldn't hit the customers we wanted to offline because it required so much in terms of physical infrastructure, and it was almost you're trying to beat the banks at their own game using their own playbook, and you haven't got the resources. So that's why we pivoted to a digital platform, and that was called PayLater, and that was the lending instantly via smartphone app. And we did that for a couple more years. And again, I think we always wanted to be a bank, but we realized that, telling customers that here's another bank that's asking for deposits, you're not really going to stand out. So we decided to give them what they wanted. And in Nigeria, and I think in lots of sub-Saharan African markets, credit is still the product that is still lacking. The retail banks don't provide it, as of when. And I think that was our wedge. So we were able to add other additional services, payments, bill payments, transfers, etc., saving products as well. And now we've got the whole sort of full suite of banking, our own debit card. So that was really the evolution. Digital lending, credit as the wedge. And then offering customers a sort of a value for money current account.
Okay, thank you for that. Tolu, how about Branch?
Yes, so I would say that I'm not one of the co-founders. I'm just the head of legal, but I will tell our story. Or starting from a purely mobile loans company. So, for example, in Nigeria, we started in 2017, and essentially the problem was to help, the underserved or the unbanked or a particular segment of the market of the economy get access to credit, and that was the problem that we wanted to solve. So again, if you think about traditional banks and how they generally related with, individuals in terms of getting access to credits. When you think about the complicated documentation process, think about requests for collateral, difficulty or the way with which they carry out credit assessments or credit assessments for individuals, and questions like you getting your ID comes up, them being able to verify your house address, or being able to ascertain that you have some sufficient credit history, and those sort of things determine whether they're able to keep credit or not. And with what's the right way to describe it now? Over the years, that has been something that makes it difficult for banks to lend to individuals. So that was the problem that we were looking to solve. Our founders were looking to solve, and they set out to solve, using two methodologies. One was trying to solve this in a way where you get access to credit in a quick and convenient manner using your smartphone data. and not going through the traditional credit underwriting model that banks have had to go through. Second is building a relationship with the borrower such that you're able to create through our loan ladder system, where you're able to, at the end of the day, build a credit history for the customer. So, for example, with our customers, when you get on the branch app, you're offered a particular loan amount, and then when you take, you're offered that loan amount, usually very small, and when you repay that, you're offered an higher amount. So essentially, you climb up the loan ladder. The more we give you the more we give you loans, the more you repay on time. The more the confidence we have that you are eligible for an higher amount, and that way you sort of build a credit history with us, and that gives us confidence to lend to you more. And with that, we also cut out some of the traditional credit assessment requirements that banks require. Complicated. I mean, I wouldn't say like zero paperwork, but complicated paperwork, requests for collateral and stuff like that. I essentially sort of cut out in our own credit assessments, and so that's one way that we've sort of addressed the problem of access to credit. So we started as a purely mobile loans company, but now we've sort of evolved towards a multi-product financial company. So in addition to loans, again, thinking about the fact that if you haven't got access to credit, if you can't get credit from the bank, you're probably not able to get other financial services from the bank. They're probably not likely to be able to want to sit with you, offer you an investment plan that helps you maximize your wealth. So with that, and with the information that we have about you, having offered you loans for one or two times, we're able to sort of help you in terms of managing your wealth. So with that, we sort of moved from just providing loans alone to offering investment products, helping you, giving you access to pay your bills, or to pay your bills of what's it called, to transfer funds at I think transfers are still free, transfer funds without cost or without charges that you would have had to pay, with the traditional bank. So we moved from just mobile loans company to a multi-product financial services company. And I see that in the next months, years, there might be additional products that we would add to our offerings.
All right, thank you. Laurin, please, if you can add to that.
Sure, yeah. Hey guys, so my name is Laurin Hainy. I'm the CEO co-founder of a company called FairMoney. And at FairMoney, really the vision is to build a financial home for clients in emerging markets. We started the firm in 2017, and we really built basically on two hypotheses. I mean, the first one was that if you want to start a bank in a country like Nigeria, you really need to start with the largest customer pain point, and as my colleagues have already alluded to, that was and is still today the credit market. I think the Nigerian consumer was and is still today largely underserved on both the consumer and then on the MSME side. And the second piece was that if you want to build a mobile bank in a market like Nigeria, you really can't just copy sort of the the approaches of other companies like Revolut or Chime or Nubank or Tinkoff Bank in Russia, but you really need to understand sort of the local context and the local consumer and also the local funding requirement. And back then in 2017 there was not a lot of funding available, and so we need to start with a product that actually allows us to build a profitable company from the get-go. And I think that is something that has paid off for us and the consumer over time. So 2017 started with lending product and then evolved over time to a full-fledged financial service provider. So today we offer credit products to the user, we offer current account product to the user, payments product to the user. And in terms of sort of number of active accounts, I'd say we are probably the largest digital financial service provider in the country today. Roughly 1.5 million bank account users, dispersed around 100 billion naira in the economy over the last 3 years. And I think that's something that me and the team are very proud of. Financing side, just raised a pretty large round with Tage Global last month. And all of that is going to help us serving the Nigerian consumer better, evolve the product. As I mentioned, we're in the lending space. We are offering payments to the customer, just offered our first debit card to user. And we really also understood that problem is not a Nigeria-specific problem. That's actually a global problem, that the sort of commercial banks are not doing the job as they should, not serving the user as they should. And that's why 2020, we also started a new operation in India, where we're basically essentially replicating what we've done in Nigeria. So starting with a credit-led model, solving the largest customer pain point, and then sort of building our financial value proposition around the user, with a final goal of, in the end, replacing hopefully replacing actually the leading commercial banks in the country with a full-fledged mobile value proposition.
All right, I think Abi wants to ask a question.
Yeah, I'd like to address my first question to Tolulope. How big do you think the total addressable market is in Nigeria for digital loans, particularly because some of your clientele will already be banked customers? And it's a bit of a two-pronged question, because then immediately following that, I'd like to ask you, could you discuss some of the headwinds that you faced as you expanded out of your home market?
Okay. So when I think about total addressable market for digital loans, I think about it from perspective of, again, for us, we don't provide like offline services, or our services are online. So I think about it in terms of the number of people that have mobile phones in Nigeria. When you think about the mobile phone penetration, I think there was a report that came about 65 million adults in Nigeria have access to mobile phones. So that gives me a sense of what the total addressable market could be lower than that. So we think about the fact that not everyone in that number is going to need a loan from us, or probably prepared to get a loan from the cash shop. When I think about the total addressable market, I think about that.
Tolu, I'm not sure if it's just me, but you're very muffled at the moment.
Oh, is it better now?
Much better now, thank you.
So okay, I'll take. Oh, okay. I'll take it again. So I was saying that when I think about total addressable market for digital loans, I think about the numbers of mobile phone penetration in Nigeria. So think about the number of adults in Nigeria that actually have access to mobile phones and are able to, apply for a loan. So I think I look at that figure. So I think there's some study that claims that about 65 million adults in Nigeria have access to mobile phones. Again, you might have to discount for the fact that some people have more than 2 phones. There are also individuals that, even though they have access to mobile phones, probably not interested in taking loans from us, even because of the size or whatever it is, and would rather take them from a traditional commercial bank. So that's the way that I would think about this market. So that also covers for whether, your question was around thinking about whether our customers are already banked customers and all of that. I think when I think about the total addressable market or where potential customers could be, so the fact that you already have a bank account doesn't actually mean that you're being served by the current banks. Also, you could have a bank account and not be able to walk into the bank to apply for the loan. You might be able to walk into the bank to apply and not, get a loan because the requirements are not what's suitable for you, but they require that, show different things. What's it called? They might require that you provide the collateral, even if your collateral is not required. There might be certain things that the bank would want to see that you're not able to provide. So take, for example, a trader in the markets that deals exclusively, not exclusively, but mostly in cash, has good trading history, but because the cash is not routed through the bank, if you walk into the bank and you're trying to get a loan, it's difficult for the bank to properly assess you, and to give you the loan that you're looking for. Even though you have a bank account, you still don't get access to the credit that you require for yourself or for your business. So that's a potential customer for us, even though he's banked. So that's the way that I would think about your question. In terms of the challenge that we faced, so again, for most of our borrowers, one of the things that we ask you for before you, in terms of your onboarding, your KYC for a borrower will be your bank registration number, which already assumes that you have a bank account. But then also just, it's just an indication that you have a bank account. Doesn't mean that you've gotten the financial services that you require from the banks that you've registered with. So, so that's that. In terms of your question around what the challenges that we faced, expanding into other countries, I would say that, one thing that that's not the challenge. One thing that we have identified, and I think the potential for credit for the markets, in the countries that we have, or the countries that we're in and the countries that we've sort of studied. So there's a huge potential for credit. So while, if looking at the countries that we're in, we're Nigeria, India, Kenya, Tanzania currently, and totally understand that, people want access to credit. They want it in a way that's easy for them to get, and that's also convenient for them to be able to repay. So that's something that we have identified in the markets that we're in. In terms of challenges, I would say that one major challenge that we have faced in terms of dealing with regulators, or just even in terms of regulators trying to understand and regulate the market. So that's one thing that is obviously common in Nigeria. So even in India, we're registered in India, we're registered as a non-banking financial company in India. And, even though that's not like a full-fledged, bank type institution, sometimes the regulations that don't particularly fit the type of model that we're running, and then you have to comply. Same thing, I think in Kenya, I think it was last year or 2 years ago, there was some regulation that prevented us and other digital lenders from accessing database of credit information, which is useful for our own credit assessment. And you have to go through the whole process of trying to engage the regulators, explain to them that this is what's needed, this is what we're trying to do. We're not saying we don't want to be regulated, but we want regulations that speak, that sort of what's the right word now, recognizes the type of model that we're running and not something that is best suited for the traditional or existing financial institutions. So there's that. Another challenge that I would say is also just sometimes in terms of manpower and talent. So again, I think this is something that might, I don't think it's common to us, and I think it's also common to, other tech companies, as well. So one other challenge is just in terms of talent and just identifying certain specific, what's it called, talented people that are able to do the work or able to, deliver the sort of standards that you want. I think those are the things that I realized.
Thank you.
All right. So my question would be to Laurin. I think you made a point when introducing FairMoney, and I think it's a point that Branch and Carbon can relate to, not copying the models in the US or other global markets and bringing it to Nigeria. Coming with a credit-led approach, first. But what I want to know is if there are like global neobanks, right? So I would want to know from FairMoney's perspective is if there are global neobanks you are kind of trying to adopt, maybe if they have a playbook you're trying to adopt their approaches, and how is it going for you? Do you have what's it called, a global playbook that you're looking at to adopt into Nigeria and India, for instance?
Yeah, sure. Thanks, Ed. So I think let me get started by just saying I think we all know that there is no playbook for Nigeria. It's too much of a complex market. But when we did start the company, me and my co-founders and today the management team, we do look for global comparisons. And actually the way we look at it, we don't necessarily only think about it from a other neobank perspective, but we look at which kind of financial institutions did revolutionize the way we bank today in other geographies. And there are 3 to 4 companies that we are looking at that we thought have really executed the model really well and thoughtful and have sort of really changed the clients' lives in these countries. So one of them is definitely a Nubank in Brazil. Now the 4th largest commercial bank in the country after 8 years of operations. I think they have 40 million customers. Incredible product. A similar company I would say is Tinkoff Bank in Russia. A very similar model, credit-led approach. Started with a credit card, and then sort of moved towards other lending models. Moved into SME lending, moved into asset-backed financing. Then started to offer the clients, a deposit solution, and is now, I think, with 6 million clients, also one of the larger banks in the country. And then, not to forget, is of course Capital One in the US, another company that has approached the problem that we are trying to solve in a similar way. I guess what all of those companies have in common, what I've just said, is that the models are comparable. So you do start with a consumer focusing or an MSME focusing credit product. Use that as a first product for the customer, get them on the platform, and then build this ecosystem around the user. Build the trust that at one point also the salary account will move to you. At one point, the first sort of instinct I always tell my team what we want to do is we don't want to build a product. We actually want to build an instinct for the user that as soon as there is any kind of financial services need, you're going to our product. That's the idea. And I think that's what these models have executed really well. And that's what we are also trying to execute really well. And I think there's 3 to 4 things that we use as really as comparisons where we think that the execution has worked. First of all, I think from a way that these companies are run, from a way that we are trying to run the companies in a very data-driven approach. If you ever hear someone from Tinkoff Bank or Nubank speak, you'd hear that most of their credit decisions, and actually really most of their product decisions, are driven with an MPV approach, right? So you're looking at sort of the unit economics that a certain product drives for you, and then make decisions. And I think that is something that we like, that we do internally. And for me, as a founder, that's very important, because I believe that's the way how you can build a sustainable company. So very data-driven approach, very unit economics-driven approach. Then of course, and I'd say that that's a no-brainer, extremely customer-focused product approach. So we're not building a product for us, we're building a product for the user, and it's the user in the end that needs to drive the roadmap. And I think that's the reason why sort of a product like Nubank within 8 years built the five largest commercial bank in the country, because they have solved the problem for the user. And I think we try to approach the same. And then, I can't emphasize it enough, what's necessary is capital. If you look at these companies, the amount of money they have raised, it has the reason why they needed that, because you need to really invest in talent. You need to really invest in the product, and that costs money. And, I think sort of with our latest raises, we've sort of shown that in Nigeria, the companies have the capacity to raise significant amount of money. The capacity to attract investors like Tiger Global, and not only on the really equity side, but we are all lenders. So, we are now financing our book in Nigeria, for example, exclusively with Naira. So we have a capital markets operation in the country that helps us to, finance our book. And so the capital aspect is a very important one, and we are really focused on that. And then lastly, I think the one point that drives everything is talent, right? Tolu has mentioned that, whatever these verticals are, in the end, you need someone that gives the right impulses. You need someone that knows how to execute in a specific vertical. And I think Nubank, Tinkoff, and also Capital One have done that really well, hiring, recruiting everywhere in the world, where you already have seen these models, and where you maybe then don't need to reinvent the wheel. And we think really similar around this, right? If you look at the company today, we are around 250 employees, growing roughly 30 to 40 employees a month. And if you look at where we are growing, we have employees today in 13 countries, right? So I think we are loving the ideas, and we have a value in the company. It's called Talent Has No Passport. We're really in love with the ideas to sort of merge, different intellectual capacities from different countries on one specific problem, which is how to build the best, financial service provider in Nigeria. And I think that what makes us as a company different, our product different. And in the end, that is for me the one single key to succeed. The other ones are catalysts, but the real unlocking factor to replicate these successes for me is talent, and talent only. And I think there we have shown in the past and will in the future that we're able to attract the best people in the world. Yeah.
Yeah, thank you for that, Laurin. Yeah, Abby.
If I could direct my next question to Chijioke, as you think about developing your new banking proposition, how do you go about building trust with your customers and developing a top of wallet strategy with them? And what kind of hooks are you finding that really work and are sustainable and attractive beyond just lending?
Thanks. I think so. For one of the things that we did to sort of engender trust in our customers, a couple of things is transparency. So, I think Carbon was the first to give free credit reports to all its customers. So, you can download our app, and even if you're not a customer, you can just, view your credit report. And that was because, we wanted to show customers that not only, are we lending to them and making money from them, but we're helping them build a positive credit report that they can go to their banks and get, a cheaper loan, maybe, if the banks were willing to lend to them. And that's us saying, like, we want to make sure that you're better off financially, and that you're creating this positive track record that would make it easier for you to access capital, loans, from any financial institution. So that's one. I think also, publishing our accounts was also one of the things we did to show people that, look, we want to be the custodians of your money. And whatever fintech companies can say about banks, people trust banks. And so we want to, and I think fintech, the average person, woman on the streets is seeing like, all the money's been raised by fintech companies, and it looks a lot like young men, which unfortunately fintech companies are heavily skewed towards men. And it's okay, what are they doing with the money? How do they make money? So we wanted to make sure everyone, okay, this is how we're making money. This is how we're spending the money. Like banks are very transparent as well. They publish their accounts, on a quarterly or half-yearly basis. And I think, because our vision is to be the dominant Pan-African digital bank for Africans in the diaspora. And I think that to do that, we need to make sure that people actually trust us. It's not only just because we're cheaper, because then that is temporary. I think what's important is that we build trust where people feel like I trust these people, not only with my transaction money, but actually maybe my salary or even my savings. And I think it's not going to be overnight. I think that's actually probably the biggest barrier to fintech to really going mainstream is the trust issue. And I think especially when you don't have many branches, our strategy is not to have branches. So compared to, let's say, Citibank or First Bank of Nigeria, UBA, where you see branches everywhere, that, okay, my money is there. If you're somewhere, I don't know, even in Lagos, if you're in Surulere and Carbon's in VI, where are they? I don't know if my money is safe, especially if there's downtime in sort of payment infrastructure. So I think it's that's what we're doing to engender trust. Look, in terms of share of wallet, I think that like Laurin was talking about, data-driven decisions to make products. I think that there's also a danger of just stuffing customers with so many products. We know the playbook. It's going to be maybe crypto, if that's a polite word. Or it can't even say FX anymore because we can't even touch that. But actually, yeah. So when you think about the playbook for neobanks around the world, it's crypto, wealth tech, it's FX, it's remittances, all these things that we can't do.
Yeah.
Exactly. So, but I think someone once told me that you can do it very well by making sure that you do the ordinary things extraordinarily well. And when you look at the angst from customers, certainly in Nigeria, things like, imagine if you built a product where you get instant transfers, instant refunds on failed transactions. I mean, we do that at Carbon. It's not perfect, but it's something we're working on where, we don't want to trap people's money. So it's those little basic things that I think, in addition to exciting new products that people actually want and that improves their lives. But I think that sometimes it gets forgotten. What gets forgotten is the basics. So it's about, okay, what new shiny product do you have to get customers? And one of the things that we've done over the past is I'm more relaxed than I was, let's say, 4 or 5 years ago, where other companies announce these massive products, and we've done massive products and they haven't worked as well. And we're like, yeah, okay, we have the same customers, we know their price points. So I think for us, it's while we will, we are bringing out new products. I think some of the doing the ordinary things extraordinarily well, and we still have a lot of room to improve customer service. Failed transactions. Doing those things well, I think will definitely increase our share of customer volume.
Awesome. So no unnecessary reinventing of the wheel then. Just focusing on what works. Okay, great. Thank you.
All right. So this question is to all the speakers. So what license do you operate with in Nigeria? I mean, I won't say it's obvious, but I'd like to hear from you. And also, given the recent announcement by the CBN and also microfinance licensing and whatnot. So do you operate with those licenses, or are there other additional licenses you have that people don't know about? Okay, sorry. I'll go with Chijioke. I mean, since we just finished up with you.
Me or Laurin?
Okay. No, go ahead, please.
I think my network was bad there. Yeah, I meant Chijioke. Yeah.
Okay. Yeah, we have a microfinance bank license.
Sorry?
Yep, we have a microfinance bank license.
Okay. I mean, do you think you should have? Do you think a different license should be created for, lending companies or digital banks in Nigeria?
Look, I definitely think that the innovation always outstrips regulation. So it's going to be catching up to do. Maybe more clarity on the licensing, because a lot of people say they're regulated and they have different licenses, but then I think they downplay the actual differences, because give an example, a money lending license and a license from CBN has different restrictions and different responsibilities. And yes, they might be regulated, quote unquote, but one, there's a different time. It takes a different time to get those licenses, and the scrutiny is a lot more in some of these licenses. So I think I think it's important to protect customers, because I think that there's a lot of abuse in the digital lending space. I'm glad to say, none of my fellow co-panelists are part of that, but there's a lot of, digital lenders using customers' data recklessly and in a way that it really doesn't help the industry at all.
Okay. Laurin, do you have anything to add to that?
Yeah, I mean, look, I want to agree with Chijioke here. I think so. First, to answer the question, you're also operating on a microfinance banking license. And generally, my view on on licensing is, and I think we've been able to educate us a bit in that way, because we are operating now in multiple countries, and so we have, for example, the difference between Nigeria and India. I'd say India is probably in most of the ways when you look at infrastructure, but also payment infrastructure, customer education, but also when you look at how the licensing, is actually organized a bit more advanced than Nigeria. And I think overall, in the company, we really appreciate a clear licensing system. We actually, even though, it's some of these licenses, especially from CBN, are not easy to get. It takes time and can be extremely frustrating. But, it also does something to the market, which is really important, which is what Chijioke just alluded to. It's enforcing good practices. And it's also keeping bad players out. So, sort of contrary to maybe the overall opinion, me personally, I guess generally, well-funded, serious, and sophisticated fintechs actually are usually pro-licensing, having a very strong central bank that sort of sets a clear rulebook out on how you can play and how you cannot play. Because I think in the end, we all have the same interests, right? We want to develop a market that, that is not only there for the next 6 months, but really for the next 100 years, right? Internally, we always talk about building a 100-year company, being there around in 100 years. And to be there in 100 years, what you need is a clear regulatory playbook, right? That's one of the most important fundamentals, so that there's no anxiety from the regulators' end on what companies are doing, and then there's also no anxiety from the companies' end on what which is the right license. So overall, I think from our end, from family's end, and I again agree with Chijioke here, we do appreciate a very clear, well-designed, well-thought-through licensing process. And if that is then a separate licensing, for digital banks particularly, why not? I think actually that's a good idea. I also, however, think that the current microfinance banking license scheme is a proper license, right? It is pretty stringent. It enforces strict compliance, and it makes sure that customers' deposits are safe. And I think that's the most important for us as a company, and that sort of the clients are protected. Yeah, that's my thoughts.
All right. Tolu, would you like to add to that?
Yeah, so I mean, apart from saying that, considering that we have a finance company license that's issued by the CBN, which we agree with, Chijioke and Laurin in terms of um, making sure that to an extent there's clarity and there's certainty from the regulators that what regulations apply to a predominant international business and businesses like ours that are traditional, that are to an largely very digital. The models are different. We don't access customers, onboard customers in the same way traditional banks do. We look or we view things different from traditional banks. So sometimes I see, I see I don't want to say a misfit, but it's just not fit for purpose. Some of the obligations or requirements that we're required to comply with because we're regulated by the CBN. You think about these things like this is clearly suited to existing traditional financial institutions, and then you have to find a way to comply because you're regulated by the CBN. So again, I think I speak for quite a lot of people when I say when we say that I'm pro-regulation to an large degree. It's useful to have regulation. Again, we're talking finances, we're talking about people's money, people's investments, loans, or whatever it is. So to a large extent, I'm pro-regulation, but it should be clear, it should be fit for the model. So I know that it's a lot of work for the regulators themselves. To an extent, they're always going to try and catch up, but it would be great if they're able to catch up faster and able to come up with or look at the existing regulations and see where amendments can be, exceptions can be made for very, very, very digital model businesses. Yeah, that would be my opinion.
Right.
I'd like to ask another question, and I'd like to pose it to all of you. I mean, given your business models, we cannot, ignore the importance of asset quality. Starting with you, Laurin, could you please just tell us, what segments of the market you focus on, what kind of NPLs are you operating on, and how do you address recovery issues? And is that something that fintech should be paying a lot more attention to in this day and age?
I mean, sure. Yeah, happy to take that one. So, I think first of all, on the asset quality side, and you already alluded to that's something that is very important for us as a lender. Well, maybe let me actually start with sort of the customer segmentation. So how we are thinking about the customer segmentation differs a bit from what Tole has thought. So we, very broadly, we are dividing the market into 3 different segments. So you have unbanked, underbanked, and then fully banked customers. And then in each of those subcategories, you then have different credit facilities. So you would have more short tenor, relatively high APR loans, unsecured, and then you have anything that is sort of in the mid tenor range from, let's say, 6 to 18 months, and then anything that's larger and potentially secured, right? And that you have in the underbanked segment, in the bank segment. And traditionally, when we started, see there's a curve. We've moved very in the left from underbanked, unsecured, and then moved towards the banked users. So that was a bit our journey, relatively low, short tenor and relatively high APR. And over time, over the last 4 years, we've actually really managed to move our book, towards a relatively large average ticket size, and then also relatively low APR, right? Actually, if you look at it, in some of our facilities are now competing directly with the commercial banking sector, right? So for some of our facilities, you could actually get the same price that you get on a GT Bank loan facility at FairMoney. So that's how we've evolved the book. So then you asked about sort of asset quality level. I think it's actually public. We would be targeting on a book level, sort of NPLs of around 10%, which we think is good in the market. It is, in my view, unfortunately still too high, right? But there's only so much that you can actually do as a lender with underwriting. I actually think that from an underwriting perspective, we've done a very good job over the last couple of years, and you actually have like sort of technical indicators for that. In underwriting, you would call it area under the curve. In Nigeria, models perform very well, but there's also underlying infrastructure problems, right? So, if I compare Nigeria with India, the hit rate of a credit bureau in Nigeria is roughly 50%, whereas in India it's 98%, right? So sort of 50% of the customers that apply have a credit bureau file, whereas in India, 98% of the customers that apply have a credit bureau file. And that, that is a bit, that at one point gets a blocker on the underlying asset quality. And I think, when we talk about regulation, actually, yeah, you need to talk about how to regulate the fintechs, but you also need to talk about how to regulate those that actually supposed to build infrastructure. And then you also need to think about how do you, how do you enforce good behavior even from unregulated fintechs so that they are not driving up the NPL costs for the entire industry. I think that is something in Nigeria where we unfortunately not yet there. And sort of, from a regulatory perspective, I think for the best thing in my view that the regulator today can do is just improve the credit bureau system. All of the other symptoms in the lending industry, such as relatively high pricing in Nigeria compared to other markets, those things will get solved over time. A sophisticated player get larger and larger, but even a sophisticated player cannot solve, for non-regulated lenders that don't report for the credit bureau. So I think that's one of the perspectives how I look at the problem. From a recovery point of view, I think one thing I'd like to highlight actually in Nigeria itself, what we're looking at is what we call the natural default rate. So imagine you give 100 loans, how many do get back without any collection or any underwriting? And, contrary to public, like I'd say, widespread public opinion, even within Nigeria, in Nigeria, that number is really good. It's outperforming most emerging markets where we either are operating in or looked at. So the Nigerian consumer generally doesn't like to have outstanding debt and not pay it, right? I think that's a very important, I always talk about that because it's a very important, I think our country has sometimes not the best reputation, right? And here it's clearly data-driven wrong. The Nigerian consumer pays much better than the average consumer in many other emerging markets, right? And yeah, on the collection side, we do regular collections. We don't do any physical collections, given that our average ticket size is still relatively small compared to the average consumer book in the in a commercial bank, for example. And I think one thing when we talk about collection, and Tage was just alluding towards that, I think very important for us, we have very, very strict customer protection principles when it is about how we collect, and also when it is about how third-party providers that work with us collect, and very strict sort of QA processes to make sure that a customer that is not paying gets treated very fairly. And then in the end we do use the credit bureau system and report people, customers that are not able to meet their obligations. But I think also there's some space, so for the regulator to step in. And I think recently we've seen a first action of the NDIC against one of the unregulated players that has actually had relatively ethically bad collection practices. And yeah, maybe when we speak about what the regulator can do, I think the way that some companies, and obviously no one here on the panel, but more unregulated companies are collecting their facilities, specifically in Nigeria, is unfortunately not in the interest of the customer, and also clearly not in the interest of the industry. Yeah, I hope that could shed some light on our thinking on that point.
That's great. Thank you so much. Chijioke, could I ask you to please, give us your thoughts?
So, in terms of the asset, our target base, we're squarely in the underbanked space. So all our customers, at least in Nigeria, has to have a bank account, whereas in other markets, we use, because those are mobile money countries, we can actually lend and interact with customers that don't have a bank account. So in Nigeria and Ghana, it's unbanked and underbanked, whereas in Nigeria, it's squarely underbanked because we require BVN, a bank verification number for onboarding. Look, in terms of our asset quality, our NPLs around 11%, and they're trending down. Our rates go right down to 0%, where we actually provide financing to customers up to 6 months at 0%. And then, we think that there's a huge opportunity to change the way people interact with loan products. So typically, our demographics about 70% men, roughly about 20 to 35 years old. 40% identify as self-employed. Over 50% are graduates. So it's these are banked customers that don't feel that they're getting enough services from their banks.
Thank you. And Tolulope, your insights, please.
I was just going to add to what you said in terms of asset quality. So again, for us in terms of our loan products, you certainly need a VPN to mean that to an extent, but looking at banked customers or banked individuals. So essentially, we have to start getting people that are banks, but that are generally not satisfied with the quality of financial services that they get it from their primary banks or get it from traditional banks. So we start. We're able to provide credit to you that you don't not have obtained or gotten from the bank, or you not have gotten the timeline that you need, the loan for. In terms of our support at NPL levels, I can say that we're still around. It's a single digit figure. Sort of, I think it's a testament to the credit assessment, our credit assessment and what's called borrower review process. At least currently for now. For recovery and collection, so we don't do physical recoveries. We work with collection agencies on a very strict, what's it called, SLAs, and compliance with our recovery and collection principles, where you have to respect the customer, so giving the harassment, share customer data with third parties. So you never get a message from branch or from someone who wasn't to the branch claiming that someone has gotten a loan and it's your name as a guarantor, whatever it is. So we do not do that. We are very strict and very strict on ensuring that even though you're a borrower, you're still protected the dignity that you deserve.
Can you come forward, please?
Tolulope, you're a bit muffled again.
Is it better now?
Yes, that's great.
Yeah, okay. So I was saying that, even for collection, you work external collection agencies and, under very strict terms of, with them complying with our recovery and collection principles. So even as a borrower, we respect you. We deal with you as a human being and with the dignity that you still deserve, even though your loan is outstanding. So we would never harass you on the phone. We would never send messages to your contact saying that you've gotten a loan from branch and the loan is outstanding, stuff like that. So we certainly do not do that. And I would say that so we don't do physical recoveries as well. So again, all of this would be you'd be contacted with the number that you have provided to us, and that's the limit in terms of how we try to recover our loans.
Actually, Abby,
Yes.
Abby, one thing I would, if I'm taking requests, I would say that RENCAP should ask the banks specifically on the NPLs on their consumer side. When you report it, it's always like the bank. But if you actually tease out a lot of the consumer and the digital lending, the NPLs from some of the banks, you would find that we're actually doing a lot better than them.
Thank you. No, we'll definitely ask that question.
Yeah, okay. Nabi, can I go on?
Please.
All right. Yeah, so I think one question I wanted to ask would be around your approach to digital banking, which is credit-led for branch, for carbon, and for FairMoney. In recent times, we've seen other new bank players, like in Nigeria and in Africa, adopting the deposit-led approach, right? And those companies are kind of morphing into trying to provide credit or overdrafts for their customers. So I see them trying to eat into your market. Do you envision yourself, taking deposits too, just as they are trying to enter credit? I don't know if that makes sense.
Sure, happy to take that. I think makes absolute sense. I think in the very beginning, I sort of alluded to our thinking when we started the company, and obviously we did look at two different approaches: start with a credit-led model and then take deposits, or start with a deposit-taking model and then at one point offering credit. I think our thinking was and still is that if you start with a credit-led model, there's basically only upside and very few downsides that I see. Obviously, there's some bias here, but let me elaborate a bit on the upsides of that model. So, for example, Nigeria, there's now one of the larger, probably the known sort of digital bank that's also raised at the same time than we did. But if you really look at the economics of what they're really trying to build, you'd realize that in terms of customers, we have a few 100,000 more customers than them, but we also have roughly 400 times more revenue, right? Just on an analyzed basis last year, right? So if you look at that, and I sort of keep on wondering just what is actually the business thesis behind these models, because even today, so if you check out any publicly listed commercial bank anywhere in the world, you would see that roughly somewhere between 65 and 95% of the revenue comes from a lending, right? So, banking is in our view, and so I appreciate people might differ, but in our view, banking is not a subscription model, right? Banking is not a high touch subscription model, like some of the sort of messengers. Banking has a different business model. And I feel, while we in my company, and I guess some of the other panelists here, try to innovate on the way that we distribute financial products, we don't try to innovate on the business model of a bank. I feel that's not what we want to do, right? That's not what our mission is. We believe that the reason why banks are the oldest business in the world, or one of the oldest businesses in the world, why they have been around for thousands of years, is that the business model works, right? I think there's absolutely no, in my view, there's no need to reinvent the business model of a bank. I think there's a lot of need in reinventing the customer centricity of how banking products are actually distributed, and then also, building the product around the user while keeping the same business model, right? And I feel, we've seen, I think in Nigeria, Chijioke, you've been around for some time. I think we've all been around for some time, so we've seen models come and go. I think that will always be the case. There will always be models that come, then prove not viable, and then go again, right? And for me, that is one of those, especially on the sort of either purely payments place, or purely high touch deposit taking place without a clear business model. So I think that's sort of my 2 cents on that. Yeah.
All right. Yeah, Chijioke, I know you want to add to that.
Really? Look, I think that, investors like payments. They don't like credit because they think it's too capital intensive. So it's a great story to focus on payments, but interchange in our markets are really low, so they can't really sustain. They can't sustain a business, and I think that I haven't seen, and who am I? But I haven't seen any good examples globally of rushing into credit, trying to create a book very quickly and not get hurt. So I think it's, for us, we firmly believe in the credit-led digital banking model. We think that, while I respect payments, I think, it's not easy. I think it is probably better to go from credit to deposits and deposits to deposits and transactions to credit. So it's just going to be watch and see, and I think the proof is, the results will speak for themselves in maybe a year or two. But when I look globally, Laurin talked about Tinkoff, Nubank, Capital One. I would even add Capitec, which was a lender first, and now it's probably one of the biggest retail banks in South Africa. They're profitable. At least Tinkoff is. So is Capitec. Haven't really seen that sort of transaction-led digital bank being profitable. I think they've been sustained by their investors by multiple rounds. So we'll see.
All right. So do you want to add to that?
I think that just from my own personal perspective, it's a question of are you looking to be your customers' only financial services provider? So are you looking to be just the only entity that they look to for their financial services or financial things? So you want to be able to provide credits, you want to be able to manage the money, and that means does that mean that you be able to accept their deposits, offer them investment or wealth management products, offer them payments products and all of that? And I think that for us as a company, I think it's a question of what our customers want or what our customers prefer. What are we saying? Are we getting a lot of requests for what's called for deposits? So currently we have an investment product and we've seen a lot of traction with that. So we launched that earlier this year, and we've seen a lot of traction. We've seen people ordinarily would not even have had to use branch, because probably they need our loan amounts, but are interested in the investment products, and we've seen those people come on board as new customers. And I imagine that, maybe in the next couple of months or years, there might be some sort of request or some sort of, tangible, figures that would maybe warrant us moving into the space where we're able to accept deposits, or maybe just even diversify our investment products such that we're just able to maximize that for the customer. So yeah, it might be, might not be.
All right, Abby.
Yeah, before we wrap up, and just thank you for your time, I just have one question. You all mentioned something, and I couldn't help but take notice. You all mentioned talent. In light of how fast growing and just how exciting your space is, how are you able to retain and protect your talent? And also, again, I mean, Laurin mentioned that there is no playbook in Nigeria. The market is so difficult. Chijioke, you mentioned the fact that, the things that fintech, the fintechs want to focus on, you can't in Nigeria, be it FX, be it crypto. Do you also find that a lot of the quest for, the battle for talent is coming from domestic peers or more from international peers? I'd just love to hear all your thoughts on that. And Tolulope, if I could please start with you.
I think it's both. So just in terms of the pressure for talent, I think that it's both. So locally and internationally. So I was having a conversation with someone last week, and he was saying that one of the developers certainly has at least 3 jobs, working for them, working for someone locally, and working for someone that's paid in dollars. And that's just the reality. So I think he had fired someone before, and then found out that this was what's happening with this current developer. And that's just what it is. So, when you find talent that is in Nigeria, understands the market to an extent. So whether you're in Nigeria or you're in Switzerland and you're building for Africa, you would want to get that sort of person and get them on board. So the competition for talent is both locally and internationally. And I think for us, it's a question of how do we make understanding that people might be here for the long haul and they might be here for short stints, but while they're here, how do we make them feel valued? How do we make them put giving their best? What do we do to make sure that people are properly recharged, and how to make sure that they feel like they're part of what you're building, something that's important to them, to their career, and to the company. So I've just seen that we have 4 minutes left. So I was going to go into like the different fancy things that we have. So we have dolphin days, we have very attractive leave and vacation and stuff like that, that we do at branch, all in a bit to just make sure that people feel that they're part of something useful while they're here. They're able to stay longer, just maybe stay a bit more longer than they probably would have stayed somewhere else.
Okay, thank you. Chijioke?
Look, I think that we probably all do similar things. The world has changed. COVID has made remote work something that is normal. In terms of carbon, I think competition is really mostly international. I think the Nigerian talent is now it has always been, but I think now that COVID has made remote so accessible, so we face a lot of competition from global names actually, like household names, and also Canada, and the challenge is, it's not even enough to earn dollars and work in Lagos. People actually want to leave, and we can't really do anything much about that. I think that with all these, and I think this is why the likes of Paystack exiting is really helpful, because now options now become real meaningful, and I think that it's not enough to announce these wonderful raises that we're seeing. I get lots of this, but it's, are there going to be exits where the average employee actually now makes $500,000, or $700,000 in options because their company got taken out, or IPO'd or SPAC'd, etc. So I think that's the last thing, because you can do all these wonderful things, but at the end of the day, if somebody gets an offer to, Ireland, the situations, I know situations where people have been paid dollars in Nigeria, but they got an offer to live in Germany, they're gone, and not even, and it wasn't even as competitive as just staying in Nigeria and earning dollars, but it was Germany, they're gone. So I think that maybe with options, maybe with more companies actually exiting and showing real returns, that we can also add options to the mix, because we give them, but it's like it's paper unless unless you see lots of companies, lots of people making a lot of money from options, exercising options.
Understood. Thank you. And Laurin, could I ask you to have the last word, please?
Yeah, sure. So look, I think it's a great question. As I think about it, I think, prior to COVID, when we would be hiring, we would really look for 4 things. So we'd look for a strong cultural fit, for the right skill set, obviously, for a very high degree of mission drivenness, and then also for the right location. So these are the 4 things that you'll be looking at in one or the other way in getting people on board. I think what COVID did is it just removed the location item on the one hand, but it also, on the other hand, or at the same time, sort of created a level playing field for employees, their expectations towards the company and what the company needs to deliver towards them in order for them to stay. And I think I agree with what some of what Chijioke was saying. I think overall, I think it's a great development, right, for sort of the Nigerian engineer now to get access to dollar payments and or the same perks that sort of someone in the US or in Canada has. That's great for the employee. And I think it's also great for the company because more and more companies, us included, are now actually hiring worldwide, right? So I don't see it necessarily from the perspective of, US companies or Canadian companies start to, poach our engineers. I actually see it from a different perspective, as is, we are actually now hiring in Ukraine, right? Or we actually have now 50 engineers or 50 employees in India, right? Or we're now starting to, hire data scientists in Estonia, right? So all of those things, I'm not sure we would actually have gone there as a company without COVID as the accelerator. That has some downsides. Yes, the overall sort of the level playing field is everyone has now the same expectation towards the employee, which is great for the employee. But it also has a lot of upsides for us as a company. I can't be more grateful for that development. Actually, I mean, from a talent perspective of what has happened to the company, I was looking at the statistics. Pre-COVID, we had employees in 2 countries and roughly 80 employees. Now we have 250 in 13 countries, right? And I don't know how that statistic would look like without the shift that we've seen in the last year, but I'm sure it would look different. I mean, I'm very sure it would look different, and I'm also sure it would be less beneficial to us as a company, and then in the end also to the Nigerian consumer that now gets access to products that are built sort of anywhere with a great skill set that's available worldwide. That's my thinking around the topic.
Thank you so much. I see time is fast spent and I can't ask any more questions, and I have so many more, but we're going to have another panel session at some point in time and invite you all back. That has been so insightful. And I just wish to thank you all for your time. Chijioke, Tolulope, Laurin, and my co-moderator Tage. Thank you all so much for your time. Ladies and gentlemen, thank you for watching. Have a great evening. Thank you.